They wheeled out last Friday, spokespersons from BlackRock and all, onto the major financial networks to tell you everything's all right. And I learned from 42 years, when they're doing that, it's not all right. Because when it's all right, you don't have to worry about things. But when you got to go out and try to hold hands, that's another situation. So to answer your question, the Iran war, how it ends up here, other than a total victory and a total change there, is not a net positive. I think also what we're going to get out of this is we need it, and I've said this over and over since getting out at the almost top of the gold. We need it after the parabolic decline to build the base again, and ideally for gold just above 5,000, and that's exactly what's happening. Darryl, you have to understand, we were talking early before we started. 5,000 was just a pipe dream for most of us 10 or 20 years ago. Mm-hmm. Now 10,000 is 20,000. So building a base here after the tremendous rally that we had the previous 18 to 24 months is very healthy. And I have to tell you, I was a little more impressed today on how quickly silver turned and finished up sharply. And now we're trading in the 80s, and we still have people disappointed because it should be at 200 or 300. No, the way gold and silver and copper are trading stands for very much higher prices down the road. But down the road, not tomorrow, not next week, or maybe not even next month. I think for the near term, which for me is 1 to 3 years. And, when I was a money manager, we never gave a forecast without a 3 to 5 year outlook. You talk to people now about 3 to 5 years, they laugh at you. 3 to 5 months, maybe, Mr. Grandich, but not 3 to 5 years. But I think if you're investing for the long term, the arguments still that exist to own physical metals have not changed. We're seeing again how out of whack countries are with their fiat currencies through debt, through mismanagement, etc. The inevitable implosion, whether it's serious deflation or huge out of control inflation, most paper is not going to be worth, as they say, the print and the paper that it's printed on. So I think they will always be viewed by people as an alternative to fiat currencies. What I do think, and why I've been more attuned, more bullish than over the years when I used to get yelled at for not being as bullish on silver as gold, is that in silver we just see a continuous increase in the industrial fundamental uses of it, and also copper. There's just no way you could hope for the things that the bulls speak about and not have copper play a bigger role in it. So I think it's the one area I still think, while not cheap anymore, is still playable across the board when you look at that versus, say, the general U.S. equity market or technology or things of nature. They still, to me, have 20 to 30 to 40% potential to go lower over the next few years. So my view has been, I stepped aside before the parabolic bust happened. I came within $4 at the bottom, which was just a lucky guess, I guess. But the bottom line to me was that it was going to take many weeks, at least a few months, if not almost the balance of the year, before both gold and silver would make new all-time highs. And the longer it took, the better it was for those that still want much higher prices. So my best guess, and that's all we ever do, I don't know what anybody else tells you when you interview, but that's all we could do is make a good guess here, is that we've seen the lows in gold, which is around 4,400. We've seen the lows in silver in the high 60s. But the longer we move sideways and work our way up, or what I like to call 2 steps up, 1 step back, the actual better would be to reach the numbers that some people still think that they can get to, which 10 or 20,000 on gold and 200 or 300 on silver. How long that takes, if I hoped it was 6 months and it took a year, I learned many things we can spend another show about what not to do. But I can just tell you this, it's better to be a year too early than a day too late. And I don't think we're late yet in the metals. I still think they will be higher than lower going down the road. Getting debt free and getting out of debt was something I know you've worked on quite a bit. It will not only help you financially, but it changes your mental scope, which is very critical in this world. I also think that there's no quick fixes. We've become very more short-term oriented. I talked earlier in this interview how we used to have 3 to 5 year outlooks. Now, you talk to anybody past 3 to 5 months, recognize that most times things take a lot longer than originally believed. And patience is truly a virtue. If I noticed one thing, even with my daughter who's in the 30s, patience is something that is a lost art. Yet, for some reason, maybe because our parents and grandparents had much tougher times, they learned that they only had no choice but to be patient. But patience is a very important thing, and giving things time to work out is another.
I'm not claiming that, oh, I knew that the thing was about to peak, and it was literally days later that silver comes crashing down from 120 to 70 or whatever it did, and gold drops $500 in a day. I didn't know that was going to happen. But I did know that anytime something goes like this, the odds are that there will be some correction. The longer that goes, the more the odds are that there's going to be some correction. So it's just market fundamentals. Buy low, sell high, stairs up, elevator down, that sort of thing. But we're getting off the sidetrack, but this is absolutely relevant to your question. Like, that was absolutely, if not predictable, expectable, right? At some point that should be expected. And the good news, though, is that means you get a period of correction consolidation. 5,000 seems to be the new 3,000, which was the new 2,000. We've seen this before.
Yes.
We consolidate, we build, and then we get ready for the next big move higher. That is my expectation for all the rotten tomatoes, especially the silver bulls, who only want to hear it's going to the moon today. That is my base case, that we were looking for a period of correction and consolidation before moving higher. Now I think we're in it. You throw a war into that mix and things get a little confusing. But I think that's where we were and that's where we are. And you can't ignore the war, but I do think you need to not exactly look through it, but to correct for it. Because whenever you get these geopolitical spikes and surges, they tend to revert to me.
Yes.
Moment this happened. I remember the invasion of Ukraine, first invasion of Ukraine, right? Yeah. Anytime something like this happens, Iraq back in the day, there's an immediate gut level response, and then it reverts to me. And we saw a microcosm of this just this last time with this new war or new phase of war in Iran, where it happens over the weekend. Trump likes to bomb people during the weekends and when the markets are closed. But now we've got tether gold. And over that weekend, we saw tether gold go immediately up when the news broke. And then it actually went right back down again. That was interesting. So there was a spike and it went back. Where are we at now? You might think, oh, there's war in the Middle East. Gold should be $10,000. Well, gold is the source of wealth of last resort, is your insurance policy. So when everything else goes haywire, you dip into what you can sell. We've seen that before many times. So it's partly happening now. But I think the bigger factor is the oil price going up. We're seeing a new oil shock. Everybody can see the inflation implications.
Exactly.
Inflation deniers around the world are suddenly, talking about maybe we need rate hikes. I just, before we got on, I saw a collection of headlines about central banks around the world are not just talking about pausing their rate cuts, but thinking about rate hikes, because everybody knows what happens when this primary input to everything, energy goes into everything. If energy costs go up, cost of everything goes up. So everybody sees that coming. And this is this weird knee-jerk reaction we have in markets where if investors think central banks are going to rate, gold doesn't pay interest, so that's bad for gold. So we saw some activity here. I'm not surprised to see gold struggle, if you will, in this environment, because we're not in an environment of roaring inflation that is good for gold. We're in an environment of people fearing rate hikes or fearing central bank interference. And that typically holds gold back. And it's very funny how you look at the past, but when we think the Fed might hike rates, that's been bad for gold. When it does actually do it, it'll move up at that same time. Lots of different ways we can go from that. But what I'm saying is, I think we have a much larger context than just the war. I'm not saying the war doesn't matter, but I'm saying it shouldn't distract us from the larger context that's going on. Fiscal dominance was all over the place before the war. If anything, that just throws fuel on the fire. I'm pretty sure we've talked about this in past years when silver was doing the, I'm falling and I can't get up thing.
Yep.
And I said, look, if you're bullish gold, you can't not be bullish silver.
Yes.
The GSR may widen, silver may never fulfill the dreams of silver uber bulls, but I cannot imagine a world where gold really breaks out higher and silver gets left behind. And that was right. So where do we go now? Well, if my base case outlook is stagflation, which